Friday, September 9th, 2016. Monaco 64 here, home of alternative economics and contrarian views. I'd like to talk about the government bond market today. I know it's probably a subject very few people are familiar with. You know, the average investor, the average person, when they watch the news and they report on the financial markets, they talk about the Dow, S&P, NASDAQ, FTSE, and here in the UK they talk about the pound. The pound is buying $1.30, the pound is buying €1.18. But they never talk about, gilt yields have dropped to historic lows, or gilt yields have gone higher, or treasury yields. There's very little talk about the bond markets. And when I worked in the city for over 20 years, that's the market I covered for my clients, was the government bond market. And specifically futures on treasuries, futures on German government bonds, futures on Italian government bonds. Prior to the euro coming about, there were futures on the BTP, which is the Italian government bond. The French Notional was the 10-year French bond future. JGB, the Japanese government bond. So I followed this market, and it's the biggest market in the world. It's bigger than stocks, the government bond market. And all assets are priced off government bond yields. And the reason why I want to talk about the government bond market today is that a lot of you know that there's been all the talk about how, central bank policy of zero interest rates, negative interest rates, QE, has driven bond yields into negative territory, and how there's $13 trillion worth of bonds that yield have a negative yield. And I actually think that could be history now. It looks to me like the bond market, especially the longer end, and by the longer end I mean bonds that yield, that mature in 5 or 10 years, 30 years, not the short-term, bonds like or bills that go up to a year or 2 year. Those rates can be much easier. The central banks can much better control those rates, but long-term government bond yields are more difficult to control. And I've made a few videos in the past. One of them was on July 18th, and I'll put it up in the card right now, and you can have a look at it. And the title is the 35-year bond bull market over? Have interest rates bottomed? So in this video, I talk about a 35-year bond cycle, and the fact that 2016 marked 35 years since interest rates had topped. The 10-year yield, I think, was almost like 15% in 1981. So in July of this year, the U.S. 10-year yield bottomed at 136, and actually that has been the low so far, because as of today, the 10-year bond yield, 10-year note is called, is at 161. So we're almost up 30 basis points since July. It doesn't sound much, but it is a big move, 30 basis points, especially when the yield is at 136 and it moves up to almost 166. That is a big move. In the last month, the 10-year note yield has moved up 7 basis points. And the other the other video I did was August 2nd, so about a month ago, and I asked the question, is the bond bubble about to pop? And in this video, I covered the recent spike higher in JGB yields, which was unusual because the market expects the Japanese authorities, central bank and government, to keep this policy of QE and keep yields low. But yeah, I asked that question, and I've looked at the JGB 10-year yield in July, which beginning of July, which seems like has been the bottom for all government bond yields. For now, you never know; they could go lower, but it seems to be an inflection point. But back then, the 10-year JGB yield, the yield was negative 24.5 basis points, or negative, a quarter of a percent. That's where it got to. And right now, we're almost back to zero, which is a big move again. It's a big move. We are at negative 0.02, or negative 2 basis points. In the last month, that's gone up 6 basis points. And the other government bond market that is one of the most liquid in the world, aside from the Japanese and the US, is the German government bond market. And in July, it hit the 10-year Bund yield, hit a low of negative 19 basis points, or a negative 0.19. And right now, we're almost back to zero. We're at negative 0.04. So central banks, they can control very short-term interest rates, 3-month rates, up to a year. They've got more control. They've got control of that because they can set the short-term rates, so the market will, stay around that level. But longer-term interest rates, like the 5-year or the 10-year, is a bit more difficult for them to control. They can influence them, and it looks to me like they're losing, control of the longer-term interest rates. And since the beginning of July, you could argue, the global economy is doing better, and that's why bond yields are going higher. But I don't think so. If that was the case, why would, the ECB and the Bank of England and the BOJ be still in a really accommodative monetary policy? Why would the Bank of England have done QE again? I know they can use the Brexit excuse. Why is the ECB still doing, QE? And the other interesting thing that's happening now, all these central banks are kind of running out of things to buy. The Bank of England a few weeks ago didn't have enough gilts to buy in their QE program. There's talk that the ECB is going to run out of assets that qualify for their program in November, and that they'll have to start doing other things. But that's aside from the point, though. I think we need to keep an eye on bond yields, because if bond yields, like especially the 10-year yields, continue to move higher, despite the fact that the economies are not really picking up, it could be a pretty negative signal for central bank credibility. And not that I like central banks, I'm just trying to give you guys a heads up on that. So yeah, very arcane subject, bond yields, but I think we need to keep an eye on this. I know I cover a lot, precious metals, Bitcoin, but this, it's the Achilles heel of central banks. Actually, aside from precious metals, of course, the bond market, the government bond market. If they lose control of that, like they did, in the 70s, look out. And a lot of people will say, oh, but higher interest rates, higher yields are negative for gold. Well, not when the economy is not doing well and slowing down and government has a lot of debt. And the other thing that seems ironic is that we've had bond yields dropping in the last few years in the supposed economic recovery, that we've had, according to our, financial masters. And now, when it seems like the global economy is slowing down, and the US is slowing down, and all the other countries are slowing down, bond yields are actually starting to pick up. So they've got it really, really the wrong way around. when economies slow down, the best thing is for, what happens is that people don't borrow as much. So, bond yields, go down to attract, borrowers. But the thing is, the central banks, they've manipulated interest rates so much that it looks like now when they need interest rates to actually stay low or keep going down, they're actually going to go up. So yeah, that's what I wanted to talk about, government bond yields. If you have any questions, just ask, in the comment section below, and I'll try to answer it. I know this is probably a subject many of you are not familiar with. So, but if you like my videos, please like, share, and subscribe them. And thanks for watching. And if you'd like to donate to my channel, there's 3 links in the description below. You can donate in Bitcoin, through PayPal or Patreon. Take care. Bye.